So the market average should reduce. The other thing that's important for yields, and which has driven yields historically, is leverage. And obviously in the last 4 years, levels of growth in credit in the business sector have been very low. In fact, flat if you look over the last 4 years as a whole. So balance sheets are in pretty good shape. REIT sector's leverage is at 25%, whereas it peaked at about 38% prior to the GFC. There's a lot of capacity there to reborrow and invest when confidence returns. So that would be another medium-term positive. The other one is relative yields. Investment is a relative game. We've seen equity yields start to move lower in the last few months with the equity market rally. We have seen term deposit rates or cash rates move lower since the RBA started reducing the official rate. That's starting to look more out of line now, and property will start as an income generating asset to look more attractive from an investor perspective. And if you just go back to 2008, term deposits were actually yielding more than offices. So where would you have put your money there, or was that a sign of excess at that point in time? The answer was probably yes. Foreign investors, that's the other aspect I think that's supportive of our yield story here. Growth has been very strong, and the net balance sheet exposure of foreign investors has increased by $10 billion over the last 5 years. That's adding weight of money to the market as well. If we just drill now into the sector outlook, starting with office, it's probably no surprise to anyone in the room that Melbourne had a very strong run up until about 2011, 2012. Vacancy rates very low, absorption rates very strong, driven by that sort of employment picture. And I put New South Wales there because New South Wales had zero net absorption growth over the equivalent period and really lagged in terms of employment. The key thing here is, though, that momentum has been lost in both of those markets and, in fact, across Australia. So that's why we're feeling that the office market's a bit subdued at the moment, the occupier market's subdued, yet we have this interesting dynamic of, from an investment perspective, still looks quite attractive in the medium term. You can see here that just reinforces that theme. Melbourne, very strong, was able to absorb significant amount of new stock coming onto the market over the last decade due to growth in business services employment, public administration, education employment. We will go through a phase where the Melbourne market is looking a little softer than the national, but that's really just rebalancing after a period of unusual strength there. Normally these markets do track fairly closely together. And 2015 looks like it will be the year where that starts to turn around. Again, pricing, I think, is an important story for Melbourne. During that period of strength, yields in office markets in Victoria rallied very sharply relative to Sydney. And you'd expect that, where fundamentals look stronger and where growth has been stronger, but that run's probably come to an end now. So, investors looking in and out at prime as a group, I think premium, we're quite close to balance between Sydney and Melbourne, but if you're looking at the Melbourne market versus the Sydney market, you probably won't see that degree of outperformance going forward. And in fact, I think an external investor may actually look for Sydney to move a bit tighter towards Melbourne over the next year. From a retail perspective, Melbourne, the key driver of retail rents is obviously retail turnover, and where we are in the cycle is important. Historically, Victorian rents have grown a lot more strongly than the national numbers. You can see there on the charts on the left. That's probably going to come to an end. If you look at the last 3 measures of retail turnover activity in the market, growth's barely above zero in the year to December for retail sales. So we expect rental growth will slow quite sharply in the retail sector in Victoria relative to the Australian market over the next 12 months. Industrial, I mentioned before, industrial is the sector that seems to have momentum at the moment. You've had reasonable growth in output in industrial, but you can see across nearly every capital city in Australia, we've had momentum over the last 2 years in terms of growth of rents in industrial warehouse. That really, to me, reflects a shift in the mix of activity in the economy. So the chart on the right there shows industrial real output. Traditional areas like manufacturing and utilities have been lagging for some time, but there's a lot of activity in transport, postal and storage. And that's really what's driving this logistics story at the moment. Encouragingly, we have seen an increase in real retail sales in the last year, so there are more goods being moved around the market now, and that would be driving the industrial sector as well. So we think that's still a good story for this year. We think that momentum will be sustained, and we'll get growth in industrial rents well above historical averages, and that's likely to keep pushing yields lower in that sector. So all up, I think, cut the long story short, historic norms to return for economic growth in Victoria after a period of strength. We are seeing a cyclical easing, but not necessarily a long-term shift in expectations for office and retail. So we are seeing, investor interest at the level of yield that's currently in the market. We do have strong industrial momentum, and that looks set to continue. And I think overall there are some supportive investment factors. The thing that needs to reinforce that is confidence, which takes time, and stability. But we think that'll gradually emerge in line with what Nick was saying earlier as the world starts to look better in the second half of the year. So on balance, I would say fairly steady yields, long-term growth expectations unchanged, so more of the same really for 2013. That's my piece. Now it's time for the panel session. I'd like to invite to the stage Ari Petrovs and the panel members. Ari will introduce the panel members to you. Thank you.
Thank you, Stephen, and good morning to you all. We've had the opportunity to hear about what's happening at a global level, a domestic level and a national level. But now we need to drill a little bit further into what's actually happening in the market. And to that end, I welcome to the stage on our expert panel Mark Granter, Chaz Keogh, Chris O'Brien, Danny Thomas, Andrew Leoncelli, Mark Weisel and Scott Callow. Mark, we might start with you. After 25 years in the agency game, there's no excuse for you not seeing cycles come and go. We understand and we hear quite clearly that there is weaker fundamentals in the marketplace, but there's an overwhelming supply of capital looking for a home. Can you provide some insights as to what are the opportunities emerging as a result of that capital flow?
Yeah, sure. Thanks, Ari. Yeah, you're absolutely correct. We're definitely seeing a very big pickup in investment demand and activity. The majority of that demand is chasing still core prime assets. Three good examples of that recently was the sale of 567 Collins Street and also the 50% interest in the police building and also 50% interest in 8 Exhibition Street. The other point I'd like to make is that the buyers, the category of buyers, up until recently probably the majority or a large proportion of interest has come from offshore. But in the last, certainly in the last 3 to 6 months, we're now seeing that widen and good interest coming from the listed, but more particularly the unlisted wholesale funds, and recently in St Kilda Road, some interest from syndicators who are probably taking advantage of that spread between yield and debt.